Now we turn our attention to cryptoeconomics or cryptonomics to understand the price drivers of the crypto world. Let us first discuss about cryptocurrencies' price volatility. Bitcoin's prices have been extremely volatile given the cap in its overall supply at 21 million bitcoins, coupled with demand for an asset that has increased in value in the last decade. Other cryptocurrencies such as Ethereum do not have an upper cap in the number of coins but have an annual cap. The economics of supply and demand for cryptocurrencies, coins, and tokenized assets determine their pricing in the global markets, with barriers for participation in the online digital marketplace eliminated through the decentralized and distributed architectural framework of blockchain technology. The world is witnessing a FinTech revolution on a scale never seen before. Monetary policy and cash liquidity plays an important role in the price volatility of the cryptocurrency markets. The ample availability of liquidity due to low interest rates and stimulus packages provided by various governments and their central banks ensure that funds flow more freely into assets like cryptocurrency markets. Famous personalities and influencers such as Elon Musk and even corporates such as Tesla and MicroStrategy, some of the largest holders of Bitcoin and other cryptocurrencies, have caused cryptocurrency markets to become highly volatile. The markets have seen bouts of buying and selling based on the tweets of famous personalities. The cryptocurrency markets are largely unregulated and hence the price volatility is high on most days due to the news flow. Nothing is stopping Elon Musk from making comments on Dogecoin, for example. Cybersecurity risk due to cyber theft of the private keys from hot wallets in famous cryptocurrency exchanges such as the Singapore-based crypto.com, where $35 million of cryptocurrencies was stolen, and Liechtenstein cryptocurrency exchange that saw $8 million worth of cryptocurrencies stolen, to name a couple, has put a spotlight on the price volatility caused due to the cybersecurity risk. Ban on cryptocurrency mining by China and Russia and other countries has led to increased volatility in the crypto markets. We should also touch upon the impact of cryptocurrency prices with other asset classes such as gold, Nifty 50 index, and the US 10-year Treasury yield rate to complete our session on fundamental analysis. But before that, let us analyze the correlation between the two most liquid and large market capitalization cryptocurrencies, namely Bitcoin and Ether, to check how the prices are correlated. The price movement of Bitcoin as compared to Ether, the cryptocurrency of the Ethereum blockchain, is illustrated in the price chart. Bitcoin and Ether prices are positively correlated. Bitcoin prices have increased substantially from $3,000 in December 2018 to over $68,500 in November 2021, an increase of over 23 times. Ether prices have also increased during this period from $106 to over $4,450, an increase of approximately 44 times. Bitcoin versus cash gold price chart. Bitcoin and gold prices have a negligible correlation of 1%. This implies that Bitcoin is an effective diversifier of investment portfolio that comprises of gold. During the last few decades, gold has been a hedge against inflation. But gold has been underperforming cryptocurrencies in general and Bitcoin in particular in the year 2021, where Bitcoin prices increased from $21,952 in December 2020 to $49,368 in December 2021, more than doubled. During the same period, gold prices were almost flat or rather marginally decreased from $1,860 per troy ounce to $1,793 per troy ounce. Bitcoin versus Nifty index. Bitcoin prices have low positive correlation with Nifty 50 index of approx 37%. This still underscores that cryptocurrency can be an effective portfolio diversifier and provides an alternative investment to equities. The flow of easy money due to low interest rates in the last couple of years, along with the liquidity infusion by central banks across the world, has led to a boom in global equity markets. The cryptocurrency markets were also not lagging behind and played catch-up with the easy money availability. It is interesting to view the graphical price charts, whereby an asset class such as equities that has fundamentals of companies to back up the valuations in contrast with the price charts of Bitcoin. What is remarkable is that some of the equity companies' stocks have become proxy for cryptocurrencies such as Bitcoin. These are more evident in the international markets with shares of Tesla and MicroStrategy, who are some of the largest holders of Bitcoins, aligning themselves to the movement of Bitcoin prices. Bitcoin versus US 10-year Treasury yield rate. Low interest rates in the last couple of years and expansion of the balance sheet of the major central banks in the world, especially the US Federal Reserve and the European Central Bank or the ECB, has led to availability of easy money at almost negligible and even at negative interest rates in Europe. In US, the US Fed rate was maintained at a low of 0.25% for a sustained period. There was also excess stimulus granted by the US government, leading to excessive liquidity that found its way into the global equity markets as well as into the cryptocurrency markets. Bitcoin prices more than doubled in the year 2021. In the graph, it is possible to see that there is a likely lag effect in decrease in the US 10-year Treasury yield rate and an increase in the Bitcoin prices. The correlation is only at 36% between both Bitcoin and US 10-year Treasury yield rate. Recently, with a more hawkish US Fed and US Treasury yield rate has inched upward to 1.9%, and Bitcoin prices have corrected from a high of 68,600 USD to levels nearer to 36,000 USD. With this, we have done a deep dive into the key metrics that need to be studied to DYOR and also studied how the cryptocurrency market correlates to other major asset classes to complete how fundamental analysis for the cryptocurrency markets need to be conducted.